Another question we've gotten is war chest assets have declined. What we call our war chest assets, which are our bonds, fixed income, assets that are less correlated to stock market movements. And those are generally set aside to dampen volatility or to take income from when stock markets are declining. And there are some assets in the war chest that have declined. And the question is this a worry? No, we don't think so. This same thing happened in 2008. Again, we had markets worrying. We had a rush to the exits as sellers were selling anything they could get their hands on back in 2008. And several of the assets we had in our war chest declined in 2008. Several held in, and as today, we see a similar situation. Many of the higher quality bonds have done well, and or have held their values even if they've fallen slightly. Some of our short-term bonds, our investment grade bonds, some of our TIPS, some of our short-term global bonds, and our merger arbitrage fund, they are down, but the bond market in general is down, and they're only down slightly. A couple of percent year to date. We saw the same thing happen in 2008. Some of the other areas of the bonds have fallen further, but that's why we have the assets that we hold in the war chest. These are not supposed to all act the same way. We didn't know that interest rates were going to go to zero. We could have been in a scenario where interest rates were rising, as they were for much of 2019. And in those cases, other assets tend to outperform. We want to hold a diversified fixed income and war chest portfolio that are not moving in lockstep with each other. And that whatever situation we may find ourselves in, whether the dollar is rising or falling, interest rates are rising or falling, default rates rising or falling, that we have some assets that are performing well in any of those scenarios. And we do have assets, like I mentioned, some of the higher quality and short term that have done well. And we'll plan on spending from those assets over the next several months and quarters and potentially years if it takes that long for stocks to recover. And over that time frame, we'll likely see some of the other pieces of the fixed income portfolio, some of the higher yield bonds recover as well. They did the same thing in 2008 when they fell. And then by the end of 2019, 1 year later, they were back to where they were and had fully recovered. And we would expect something similar to happen this time with our assets in the war chest.